Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at some more financial results, and we're going to focus on those Canadian or majority Canadian-owned banks on the Trinidad and Tobago Stock Exchange. We're talking, of course, about FirstCaribbean International Bank, or CIBC FirstCaribbean rather, as well as Scotiabank Trinidad and Tobago, or SBTT. Both groups would have reported their earnings for their 9-month fiscal period ended July. Let's take a look at how those companies would have performed and what investors might expect in the coming months ahead. Turning firstly to FirstCaribbean or FCI, the group would have reported an earnings per share figure of 90 cents per share, or a 73% increase from the 52 cents per share recorded in the prior comparable period. These figures, of course, are in TT dollar equivalent. Total revenues were up 28.6% from just under 2.9 billion to about 3.7 odd billion. Overall net income attributable to equity holders would have increased at 73.4 odd percent from 821 million to just about 1.4 billion. When we take a look at revenue composition for FCI, we can see a continued positive trend driven primarily by higher USD benchmark interest rates, which would have led to overall increases in interest rates for its outstanding loans and advances. And we can see that for that 9-month period, 2023, revenue growth accelerated from 8% in the prior comparable period to 28%. And that would have been propelled in large part, again, as mentioned, by that increase in net interest income in that red segment, moving from just about 1.9 billion TT equivalent to about 2.67 billion, a 40% increase, as well as an increase in other operating income moving from just about 1.004 billion to 1.05 billion, a 4.7% odd increase. So generally increases across revenue streams across the board for FCI. Certainly good news for shareholders. Of course, that would be one eye would be, of course, on the peaking or near peak US interest rate cycle, which would mean that advancing of net interest income because of benchmark rates could be coming to a pause in the near future. When we take a look at profit before tax by segment for FCI, we can see some very positive trends. Revenues or profit before tax from its corporate and investment banking segment, for example, were up just about 38 odd percent. There was a 40+% increase in its PBT from wealth management, moving from 45 million TT equivalent to just about 67 million TT equivalent. And there was also a notable increase of around 15% in its retail and business banking segment, from 79 to 91 million TT equivalent in that yellowish odd segment. Now, when we take a look at valuations for FCI, it is currently the cheapest stock by using the price to earnings ratio metric on the banking sector locally. We can see that they are trading at a price earnings ratio of about 6.4 times in comparison to that sector average of 12.3 times, and well below its peers on the banking sector, with Scotiabank Trinidad and Tobago as SBTT on the other end of the spectrum, trading at a more relatively expensive 19.1 times PE. So certainly some value seems to be on offer by FCI at a price of $7. Again, they are trading at that 6.4 times multiple with a trailing dividend yield of 4.6% compared to the sector average of 3.2%. Now take that with some consideration as well, given that FCI does pay its dividends in US dollars. So an additional attractive feature to be owning FCI shares. And with higher revenue growth in mind, driven by higher interest rates, those fairly attractive valuations, and continued modest economic recovery across the Caribbean region, Bourse is going to maintain its overweight rating on FCI for the time being. Turning quickly to Scotiabank Trinidad and Tobago, or SBTT, well, the group recorded an earnings per share figure of $2.85 per share, which was a 3.7% decline from the $2.96 recorded in the prior comparable period. Now, net interest income improved 15.8 odd percent from 913 to just about 1.06 billion. Total revenues, however, would have advanced just a very modest 1.3% from 1.43 billion to just about 1.45 billion, given a decrease in net other income, and overall income after tax down at 3.7% from 521 to just about 502 million. Now, when we take a look at that revenue growth, we can see those changes are being reflected graphically. That net interest income up that 15 odd percent, as well as that 23% decline in other income from 520 to just about 397 odd million, still eking out some marginal gains in terms of revenue growth at 1.3%. Now, for shareholders of Scotiabank or SBTT, they have always cherished that dividend, and we continue to see that despite the lower earnings, there continues to be some dividend resilience, although on a 9-month basis for this fiscal year, those dividends per share would have decreased marginally to $2.10 compared to the $2.30 in the prior comparable period. Scotiabank or SBTT is still continuing to maintain a relatively robust dividend payout ratio, averaging above 70% over the past 4 comparable periods. So at a price of $72, SBTT is trading at that price earnings ratio of 19.1 times, as mentioned, above the sector average of 12.3 times, and offers investors a dividend yield of 4.3% compared to that sector average of 3.2%. So with those, with factors such as increased net interest income in mind, of course, higher non-interest expenses also weighing on earnings in this current period, but also healthy dividends tempered by elevated valuations, Bourse is going to maintain a market weight rating on Scotiabank for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 2-Bourse or 226-8773. Email us at invest@boursefinancial.com. And of course, you can check out our website where all of our research is absolutely free at bourseinvestment.com. Until next time, stay safe, have a great investing week, and we'll see you next time on the Bourse Report.